Good afternoon. It's Friday, April 24th. I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our special weekly market update. For those who may be less familiar with Foster Group, we're an independent advisory firm located in West Des Moines, Iowa. We were founded in 1989, and since then, we've specialized in comprehensive financial planning and investment management for over 1,400 clients around the U.S. We serve both individuals, families, institutions, and retirement plans, and are happy to do so. This week's topic is going to talk a little bit about oil's Stranger Things week, and we'll look at the market review as well as usual. So let's get started. So here's just some of the news items that came up over the past week. It's been a little quieter in some regards. Started off with a bang, though, as oil prices fell in the negative territory. The May futures contract for West Texas Intermediate, what's called the WTI, oil's future price closed at an unprecedented negative price of minus $37.63 a barrel on Monday, April 20th. Those futures contracts had never closed in negative territory before, so it was quite a shock to the system on Monday. Also this week, an additional 4.4 million Americans applied for unemployment benefits for the week. So far, kind of in this crisis period, more than 26 million Americans have filed claims since mid-March. Again, quite a record. Also this week, the federal government released state reopening guidelines. So as we think about bringing the economy back online and kind of trying to move back to some sense of new normal, the government introduced a three-phase approach that has an initial gating standard for states to adhere to. It includes downward trajectories for both new symptomatic cases of COVID-19, as well as a downward trajectory for positive tests for at least 14 days. Those same guidelines require the state to have what's called a robust testing and contact tracing program in place. So states are busily trying to understand what those guidelines mean and how they're going to apply them when they get ready to start reopening some of the things that they would like to do and have their citizens be able to do. Markets for the week, again, oil was the story, and you can see here as we look at this chart again, every week we look at the S&P 500, the global stock market outside of the U.S., and then the aggregate bond market here in the U.S. Pretty quiet week in the bond market. That's the orange line across the top, pretty steady. You can see both stock markets were affected by the oil price shock on Monday going into Tuesday, losing some significant ground before coming back here at the end of the week. Really, the week had kind of been a mild or quiet week by the end, which is an interesting definition of what's mild. I think of that as anything somewhere in between -4% and +4%, given the volatility we've seen over the last month or two. A week like this one is kind of a welcome change. One of the things that happened over the last week or two, is a lot of investors have been getting their quarterly statements, looking at their investment returns, and it's probably pretty discouraging, especially for those who maybe hadn't been paying close attention along the way. But I thought what we do here is, because those quarterly statements were for periods ended March 30th, and also because we've had so much volatility in the market, it seemed like it might be a good time to review performance for the entire year, just to give a frame of where things are at and why it's so important for investors who have remained invested to stay invested. Because markets tend to be very volatile and returns can come in quick bursts. We'll see that as we look at this chart. Let's just take a look at the Russell 1000, which is an index of the largest 1,000 publicly traded companies in the United States. We kind of scroll down to the middle there, you'll see the year-to-date number, and this was again through April 23rd, so the end of the day yesterday. The year-to-date number, the Russell 1000, was down 13.46%. Now, at the end of the first quarter, so through the end of March, that same index was down 20%. But the number that I really want you to look at is the 1 month number. So in the last 30 days, the Russell 1000 is up over 25.55%. And that just seems amazing, but it's just a timing issue, because really about a month ago, March 23rd, looked like it was kind of the low point in markets. So what you had is this perfect period where if I look at the last 30 days, you could say, wow, that's been quite a return. And quarter to date, those U.S. large companies are up 8.5%. So for those of you who are reviewing your quarterly statements and wondering if things have gotten better or worse, as you kind of look across this chart, you can see that things have gotten better since the end of the quarter, though they wouldn't be reflected quite yet on your statements. I think the thing to note too, as we look at that 1 month number, is you can just see how quickly markets can turn around. And for investors who've been kind of holding through negative periods, it's very important many times that they continue to hold, because when markets do tend to return to positive returns, it can happen very fast and unexpectedly. I don't think many people were feeling great about the economy on March 23rd, and they certainly weren't feeling great about markets, and yet things turned very quickly. March 23rd actually saw the Russell 1000 up almost 10% for the day. We have a ways to go yet before we get to back to even. And if we think about that, about March 20th, the Russell 1000 was down over 29%. If you think about what it takes to recover from a 29 or 30% decline, it means that same index has to go up by 43% just to get back to break even. If you're looking at that Russell 2000 column, the Russell 2000 was down almost 40% at one point in the middle to the end of March. If you're going down 40%, you need a 67% rise to fully recover to where you started. One thing that I noticed too on this chart is you look out there at the column labeled aggregate bond. That's the bond market performance here in the US. For virtually every period, when you look there, those numbers are green. Again, that's why for diversified investors, it really helps to have bonds in the portfolio, because while equities are having a pretty serious bout of volatility, both positive and negative, not quite sure when things are going to happen from week to week or month to month, those bonds have been relatively good performers across the windows. And as well, the 1 to 3 year treasury has been a solidly consistent performer also. So the story of the week was something called an oil shock, and if you look at it, it was really a classic supply and demand story. And the problem here is both supply and demand were really out of whack. There's a website called The Visual Capitalist, which I like. They had some great infographics this week. And as we look at the pictures to the right, you can see how things came together to create what we experienced on Monday, which was an unprecedented fall in oil futures prices. First thing that happened is something we're all familiar with. As all of us have been staying at home and not traveling, there's been what's called a demand shock. In other words, people are not doing things that would cause them to consume oil. We're not flying in planes, we're not driving cars. So the demand for oil has gone way down. At the same time, there is a supply shock because Saudis and OPEC countries and Russia basically got into a game of chicken about who is going to control the price of oil. So because the Saudis and the Russians couldn't agree on how much to produce, they both decided to produce more. So imagine two of the largest producers in the world producing more oil at a time when consumers are consuming less and less and less. You can see what's happening here. The supply side of the equation is way out of whack with the demand side. What happens when that supply is way out of whack with the demand side? When there's more supply than demand, prices tend to fall. In this case, they fell precipitously. You can see that in the lower chart there, kind of tracking the price of oil and oil futures going back to January. Those numbers went down, 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 and down some more until we got to April, and we saw that collapse on Monday. So what happened on Monday? Well, there are futures contracts, and generally the people who are active in futures markets are either producers or they're consumers. They use the oil, let's say oil refiners, or they're financial intermediaries, people who are speculating on the price of oil. But they're buying contracts to take delivery of oil at some future date or to make delivery of oil at a future date. The contracts for May were expiring on April 21st. So the people who had those contracts either had to sell the contract on Monday or Tuesday, or they had to agree to take delivery of the actual commodity, the crude oil. One futures contract is equal to 1,000 barrels of oil. So producers and speculators, at the end of the day, they were willing to pay someone $37.63 to take the oil off their hands. In other words, oil was trading at a kind of like, imagine that you had a, let's say you had a brand new treadmill in your basement and you had ordered a Peloton bike instead and you were going to replace it. But you had to get rid of the treadmill because the treadmill was in the way of where your Peloton bike was going to go. So you put a Facebook Marketplace ad out there, a Craigslist ad, and said, hey, I'll pay someone $200 or $300 to come take the treadmill out of my basement. In other words, I'm not only going to give it away, I'm going to pay you to take it away to make room for my new Peloton bike. And in essence, what was happening with oil, people were saying, not only am I willing to give you the oil, I'm willing to pay you to take the oil off my hands because I don't have a place to store it and there's no demand for it at the current time. We think about kind of the amount of oil that we use every day. There's a normal demand is about 100 million barrels a day. Right now, if we look at kind of the storage problems with oil, you can see from this chart, again, from the Visual Capitalist, that a lot of oil right now, not only is it being stored in big tanks on the ground, but almost all the oil tankers in the world are being used for storage as well. You can see that 76% of the world's available storage capacity was already full before these May contracts started to expire. If you look at kind of the data in the lower half of the chart, you'll see that the cost of renting an oil supertanker has just exploded. It used to be that you could rent one of these things per day for $20,000 to store your oil. By the middle to the end of March, that same per day cost for renting a supertanker had gone to $200,000 to $300,000. Another example of supply and demand. There's not enough supply of those tankers out there, and so the demand for them is driving the price way up. Currently, you can also see there's a record amount of oil being stored in those tankers offshore. So imagine there's 160 million barrels of oil just floating in tankers at different places around the world currently. It truly was an oil shock. Some people are a little worried about, well, what does that mean for the economy? How do I think about that in terms of its effect on stock markets or prices or things like that? A couple charts that we'd kind of leave you with here. If you look at the price of oil, you can see that historically it's been a very volatile commodity. This isn't the first time oil prices have moved quickly. It's the first time they moved below zero. But you can see during the financial crisis, the price of oil rose very high, above $150 a barrel. On the right chart, you can see, though, what's happened to oil as a part of the economy. If we think of the energy companies as a part of the economy as represented by their share of the S&P 500, so what percent of the world stock market, or the US stock market, is represented by energy producing companies, you can see that as prices for oil have dropped since the 1980s, the share of the economy and the share of the stock market represented by energy companies has declined as well, to the point now where it's less than 5% of the US stock market value. So while the oil price shock got a lot of people's attention on Monday, in terms of its part of the economy or what's happening to companies at large, it may not be quite as big of an effect as the splash it made in the news media. A couple things related to that and some questions we've been getting from clients recently and others just has to do with all this stuff about oil prices and unemployment and this unprecedented government stimulus. What does that mean maybe for the future of inflation? A couple observations to keep in mind if you're worried about inflation or thinking about that. One thing to remember is that pre-COVID-19, inflation around the globe was very low, measuring at less than 2% in the United States in the most recent measurements, and it's been low like that for the last 5 to 10 years. The other thing to remember is that right now, unemployment, unfortunately, is climbing. It's now probably over 20% in some areas of the country. Oil prices, so the price that we use to produce things, the price that we use to travel, it's at historic lows. So again, if inflation is rising prices, there's a couple things going on here that say inflation may not be an issue for quite a while. One is unemployment is relatively high. Oftentimes inflation is driven by very, very low unemployment. When the number of employees available to companies to hire is low, in other words, there's going to be a high demand for those employees, so there's a supply-demand mismatch. There's something called the wage price inflation, where companies begin to have to pay more to attract workers to leave where they are to come to a new job. That probably won't be the case for a while. Again, the price of oil is at a historic low, so it's not going to put inflation pressure on prices. Consumer spending has also fallen precipitously since March. Those stay-at-home guidelines were introduced, so it means people are just spending less. Again, with less spending, less demand, the likelihood that prices are going to rise goes down. The other thing to remember historically is inflation was low and remained low coming out of the great financial crisis, and the aggressive government stimulus programs during and following that crisis didn't seem to really kindle a lot of inflation kind of coming out. So if you think about 2009, 2010, 2011, we didn't see a lot of inflation pressure, even though the government had stimulated the economy dramatically. So again, with all these things going on currently, even the record amount of government stimulus being put into the economy, the likelihood of seeing significant inflation in the near future seems unlikely. As a matter of fact, Treasury inflation protected securities, or TIPS, they traded at negative interest rates earlier this week, down about 0.5% negative. The 10-year Treasury was trading at about 0.6 at the end of the day today. So if you think about the spread between a 10-year TIP and a 10-year nominal Treasury, it's about 1% or a little bit more. Oftentimes people will look at that and say, well, that's kind of a reasonable estimate of what the market is expecting for inflation in the next 5 to 10 years. I would say the market is expecting inflation to be somewhere around 1%, given the spread between tips and nominal treasuries. Our quote for the week, as we finish the week here, there was lots of quotes to choose from. I like Howard Marks. He's the author and co-founder of Oaktree Capital Management. And Mr. Marks has been writing memos to investors since the early 1990s. He's a very experienced and legendary investor. And this is what he said about the price of oil. There's nothing intelligent to be said about the future of the price of oil. And what Mr. Marks, I think, is alluding to is oil has a lot of things affecting its prices. One of the things we saw here this year is just how two producing countries can get into a spat and cause an oil price shock that really doesn't have anything to do with the actual demand or supply for oil. They're just having a fight about price and who's going to win that pricing battle. So again, as we kind of go forward, I think oil will continue to be interesting. It'll continue to be volatile, but it probably has less to do with our economic situation. It certainly has less to do with our economic and markets situation than the public health crisis surrounding the coronavirus. So we'll continue to watch for developments. Hopefully things will continue to get better in terms of the numbers here in the United States. And as we talk in weeks to come, the picture will become clearer, states will begin to open, and we'll begin to get back to some semblance of what we think of as normal. Hope to see you next week. Until then, have a good weekend.